Unfortunately, in investing, there can be times where you are completely right on the business. You're completely right on the valuation. You're completely right on the moat, yet things come out of left field that ruin the investment completely. And in this video, the second in a three-part series here on the channel on famous investment flops, we're going to look at one such case which actually affected not one but several well-known value investors, and that is the company Horsehead Holdings. It's a story I have covered here on the channel before, but I think it's worth revisiting because there's quite a lot that we can learn from this kind of unusual investment case. It was a business that a lot of well-known investors piled into. For a time it was working really well, and it's a company that ended up going all the way to zero after filing for a pretty controversial Chapter 11 bankruptcy. So if you enjoy the video and haven't subscribed to the channel already, please be sure to do so. But without further ado, let's get into the story of Horsehead Holdings. Now, I think the overall Horsehead situation is summed up pretty well by a quote from Monish Prabrai, who was one of the investors caught up in this situation, discussing sort of a post-mortem of Horsehead. He said, "One can make mistakes in investing. You can lose money and the bet would still have been the right one to make. If the odds of tails in a coin toss is 75% and it pays 1-for-1, it is a worthwhile bet to make, even though there's a 25% chance you lose the bet." And unfortunately with Horsehead, Monish Prabrai wasn't the only one to lose the bet. He was certainly the largest of the shareholders that were involved. But alongside Prabrai, we also had Guy Spier, we had Phil Town, and we had Matthew Peterson in the early days of running his fund. So what was Horsehead, the business, and why were some of these super investors in the business in the first place? Well, Horsehead was basically a zinc producer. They were a commodity company that produced zinc and sold zinc. Although they didn't do so in the traditional sense of just mining zinc, they actually took sort of this toxic dust type byproduct from the production of steel, specifically from electric arc furnace steel production. They took kind of this toxic dust and basically converted it into the slurry known as Wales oxide, which was about 60% zinc. It was kind of a low-grade zinc slurry. There's obviously a few chemical processes involved in taking this toxic dust and converting it to Wales oxide, but from a business perspective, it was quite straightforward. They produced this low-grade zinc slurry and they sold it as a zinc commodity at whatever the zinc price happened to be at the time. Now, it's not that common actually to see long-term value style investors in commodity companies. You can certainly see them there from time to time, particularly if they're more old school Ben Graham type value investors where they're trying to buy $1 for 50 cents, flip it for $1 a couple of years later and kind of repeat the process. But the reason you don't see a lot of really long-term kind of buy and hold investors typically get into commodity companies and hold on to them for 5 or 10 or 20 years is because oftentimes it's hard for a commodity company to have a big wide moat around the business that allows it to earn superior returns on capital over a period of time. The only real moat you can have as a commodity business is just to be the low-cost producer. You have very little control over how much you can sell your product for, but if you can produce that commodity cheaper than everyone else and you can remain profitable when other businesses are losing money, when commodity prices are low, that certainly can be a competitive advantage. And that low-cost advantage is something that Horsehead were actually working quite hard to build when some of these super investors were getting involved in the situation. In 2013, where most of these investors were building up their positions in Horsehead, the business was producing about $30 to $40 million per year in EBITDA. And most of these commodity companies tended to be valued at somewhere roughly between 8 to 10 times EBITDA. Now, importantly, Horsehead were actually building quite a sizable new plant in Mooresboro, North Carolina. The development was going to cost them about $500 million, but it would allow them to add about $90 to $110 million in additional EBITDA every single year, which would take the company's kind of total EBITDA after that project to a roughly $130 million. Again, if you put that 8 to 10 times multiple on that improved EBITDA situation, that would get you to about $20 per share. That was kind of the general assessment that a lot of these investors had made. Monish Prabrai was one of the first investors to buy into Horsehead as early as the back end of 2008. He was able to buy at a little under $5 per share, but most of these investors were building their stake in 2013 and 2014 at about $10 to $12 per share. So if you could get a cost basis of about $10 per share, and you felt that Horsehead would be worth $20 per share in future when this new plant was up and running, you could justify maybe a double from the investment in Horsehead. But that all assumed quite low zinc prices, which were kind of prevalent at the time. And you could pretty easily make an argument that Horsehead would in fact be worth about $40 per share if zinc prices normalized. Like a lot of commodity companies, Horsehead was quite leveraged to the price of zinc. If zinc went up a little bit, the earnings would go up a lot. If zinc went down a little bit, the earnings would go down a lot. And we were at kind of cyclical lows in terms of zinc prices at that time. So you didn't have to argue too outrageous kind of assumptions to get maybe $40 per share across the line in an underlying analysis of intrinsic value for Horsehead. And for a time, the investment was playing out really well. Like I say, Pabrai invested at about $4 or $5 per share initially in the back end of 2008. He added pretty substantially at about $12 or so per share. And by mid-2014, the stock had actually gone to about $20 per share, at which time Phil Town actually sold his initial position in Horsehead. And Phil Town's got a great podcast episode from a couple of years back talking through a lot of the detail of this situation. This is the point, though, at which things really started to go downhill pretty fast at Horsehead. Firstly, they had some issues getting their new Mooresboro, North Carolina plant up and running. And secondly, they had a minor debt issue, which turned out to really snowball into a major debt issue eventually. And at the time, the share price started to slide from $20 eventually all the way down to about $3. Phil Town actually explained that he got back into Horsehead and eventually averaged all the way down to about $3 before Horsehead unfortunately ended up going bankrupt. And the reason that Horsehead went bankrupt is very unusual. In a lot of companies, it would be quite clear in their financial statements that they are really struggling for liquidity. You know, it would be very clear that they have a whole lot more liabilities than they do assets. But that really wasn't the case for Horsehead. They had about $400 million in debt, and the chaos kind of started when they failed to make a $1.5 million interest payment on a portion of the debt that they had outstanding. Now, the sort of principal balance on this portion of the debt was about $30 million. They were making a $1.5 million interest payment, or they failed to make that payment. But that entire $30 million wasn't due, on that day or anything crazy like that. They didn't have to come up with an enormous sum of money relative to their annual earnings or the total amount of debt that they had. So the first unusual thing was that it was weird for them to miss a relatively modest interest payment, compared to their overall debt. And unfortunately for Horsehead, that caused the lender in this situation, of that about $30 million of the $440 of debt, to call the entire loan. And Horsehead were forced to come up with about $30 million basically on the spot. And unfortunately for the shareholders, management really saw no other option than to file for Chapter 11 bankruptcy. And that Chapter 11 filing really caused a lot of angry shareholders to come out of the woodworks. Phil Town and Guy Spier definitely included. And in a somewhat unusual situation, the judge in this bankruptcy filing actually created an equity committee, which had Guy Spier and Phil Town at the very least on it. The judge was quoted in the bankruptcy proceedings as saying, "To put it bluntly, something doesn't smell right to the court." And the argument from shareholders like Guy Spier was pretty straightforward. It was that Chapter 11 bankruptcy most definitely was not the right option for management to take Horsehead down. They had other options. They could have rolled over the debt, or they could have even come to the largest shareholders and asked to, take some debt or borrow some money from those guys to keep the business going. And those sort of short-term liquidity issues aside and missing this small interest payment, Horsehead flat out still had a whole lot more assets in the eyes of most shareholders than it did liabilities, and it said exactly that on their most recent financial statements pre-bankruptcy as well. Now, there's a pretty good New York Times article from 2016 when this was all playing out that sums up basically the main arguments from each side during these bankruptcy proceedings. Essentially, shareholders argued that Horsehead had assets of about $1 billion. There was an independent KPMG report commissioned that also valued Horsehead's assets at about $1.1 billion. Yet Horsehead's financial advisor was, providing much lower asset values. They were arguing that Horsehead's assets were only worth $280 to $375 million. So it was a really unusual situation that, as you can imagine, really pissed off a lot of shareholders. And I will leave also linked down in the description below actually a transcript of Guy Spier's speech, kind of his argument that he made in court, if you're interested in reading through that as well. And a couple of kind of final things on this Chapter 11 kind of court battle that went down. The main sort of discrepancy in valuation between what Horsehead management thought their assets were worth versus what the shareholders thought the assets were worth is really this new Mooresboro, North Carolina plant. Horsehead management argued that the plant was now worth zero, even though they'd just spent about $500 million building the thing. And obviously the equity committee, Guy Spier, Phil Town, so on, felt that that plant had very real value in the hundreds of millions of dollars. And unfortunately, the way that many of these legal battles work is that, even though the likes of Phil Town and Guy Spier are arguing to try and get some money back off the table from Horsehead because there's a lot of equity still sitting there, at the same time, that equity's been eaten up by legal fees because, Horsehead management aren't paying for this out of their own pockets or anything. All of the payments for legal fees are coming straight out of Horsehead's equity or any equity that they have remaining. So Matt Peterson, in his 2016 annual letter to investors in his fund, summed up the whole situation pretty well. He said, the judge was quoted as saying, "This is one of the most difficult decisions I've had to make in 10 years on the bench and one of the closest calls I've had to make." Matt explained that after a massive valuation argument between both sides, the court eventually revised the final valuation down to $653 million. After paying back the debt, that would leave about $215 million, and after a crazy estimated $200 million in legal and bankruptcy fees, that left essentially nothing left over for equity investors and common shareholders. And to really just rub salt in the wounds, that Mooresboro, North Carolina ended up going to obviously the debt holders, as it often does during these bankruptcy proceedings. The plant ended up getting up and running, and as I understand, to this day, it is still, converting this toxic dust into this Wales oxide kind of zinc slurry and selling that for a profit. So a really kind of sour ending, unfortunately, for a lot of these really great investors. So like I said at the start of the video, I think Probri summed this situation up pretty well. Sometimes the odds are in your favor. Sometimes you make bets that, have a positive looking outcome, but there's always a chance that the bets don't work out, even if the odds are heavily stacked in your favor. And in hindsight, with the odds that were presented to these investors, I think a lot of them would probably make the investment again. And that in and of itself, I think, is quite an important lesson here. You don't and you won't get every investment right throughout your investment journey, but if the odds are in your favor, you should learn from it, but not learn too much. And that was actually something that Charlie Munger said to Monish Probri on a phone call following this whole saga as well. So what else can we learn here? Because I think that these investors were really largely right on the business. The plant ended up, getting up and running, and we don't know exactly what kind of cash flow numbers that threw off, but we do know that that did end up happening. We also know that they were probably right on the valuation using some of these conservative, profitability projections they were using. They were really just screwed over by management, to be frank. And I think we can actually do some practical things to look at how aligned management incentives are with shareholders. One of the main ones would be simply looking for a management team that just owns a lot of stock and is invested right alongside you. This is one of the reasons a lot of investors like to be invested in stocks right alongside founders or people that have gone out and bought a lot of stock in the open market, which, you can look up those public records on something like Open Insider, for example. But one quantitative thing we can definitely look at in the case of Horsehead is that they did have a reasonable amount of debt. They had about $400 million or so in kind of total liabilities at the company, which compared to their sort of new plant, EBITDA was quite substantial. They only had $30 or $40 million in EBITDA versus about $400 million in debt, so more than 10 times the annual EBITDA. And anyone that's watched Charlie Munger before will know that the I, T, D, and A on EBITDA are all very real costs, and those should certainly be included as well. And even after the plant was up and running, and if the business was producing, say, $130 million a year of EBITDA, again, you still probably had about 4 times that amount in debt, which isn't obscene. I mean, a lot of companies do get away with more debt than that over time, but if you're in a commodity business where your earnings can jump up and down, that should naturally push you probably towards carrying less debt if you can. And as Peter Lynch used to say, it's very hard to go bankrupt if you don't have any debt. So that's definitely the safest balance sheet scenario to be in. So I hope you enjoyed that story of Horsehead Holdings. Please let me know your thoughts down on this situation in the comments below. And I hope you enjoyed this second in our 3-part series on famous investment flops here on the channel. Be sure to subscribe to the channel if you haven't already, so that you can check out part 3 in the series when that comes out. And if you haven't seen it already, go and check out part 1 in the series, which was looking at Warren Buffett's investment in IBM. But that's all I've got for this one, and I'll see you in the next video. Cheers.